first idea is a Swedish company called Evolution, a huge online casino player, Jason?
Yes, they are actually technically the largest casino in the world, but probably you've never stepped into one of their casinos because their casino is online, or maybe you have. But they provide the backbone of online casino operations for land-based casinos and online casinos. They're based in Sweden. We've owned them for a number of years now. We last added to them at 1,100 Swedish kroner in September of last year. It's a very interesting business. It is, of course, founder-run, founder-owned. They have no debt. Their margins are some of the highest that we've ever seen, in the 60% range, and they've been growing their earnings quite rapidly in the 20 to 30% range. Their growth rate has come down a little bit, which of course is to be expected. You can't grow at 40, 50% forever. And we think that the company still has plenty of runway to go. This is I believe our 8th largest holding at a 4% weight. And we hope to own these shares for many years to come. And we think that at the current price, so it's trading at 19 times earnings, I think it has around a 2.6, 2.5% dividend yield for that type of growth profile, and for a very strongly moated company. So once they have customers, they typically keep them for long periods of time because the quality and the production of whether it's blackjack or they have some of these fun games like Monopoly and so on and so forth, the quality of that games is very important for the end user. So very strong business, one that we've owned for a while and hope to continue to own for many years to come.
Alimentation Couche-Tard, you touched on this one already. That's a long-term holding?
It is, yeah. So we've owned it since 2014, much like our position in Constellation. This is just a really interesting business. I think it still flies under the radar for many people. Maybe it's got a bit of an awkward name with the French Alimentation Couche-Tard. They started in 1982 with one convenience store in Laval. They've now grown to something like 15,000 convenience stores across the world. They've got excellent operations in Europe, Canada, the US, as well as Asia. The business is still quite fragmented. So they still see a long runway to be able to do acquisitions. And this is just a really great example of mirroring the operational excellence. So they are wonderful operators. When they buy convenience store locations, they're able to add a lot of economies of scale and improve the operations of those businesses with capital allocation. So they have shown a wonderful history of being able to allocate capital well. They've done a great job that we hope to own for many years to come.
Okay, you're sticking with that one, ATD, Tobila, which is a security anti-spam software player in Japan.
Yes, so speaking of competition, Tobila doesn't have much competition, which of course we like. We'll see that over the long term, their stock price has trended down, which if we remember from earlier in the show, we see this as a good thing. The stock is now below 15 times earnings with over a 2% dividend yield. Ticks many of our boxes: founder-run, founder-owned, no debt, high and consistent returns on invested capital. And we think that there's quite a significant barrier to entry for them or for competitors to come in and eat their lunch. They have 15 million users. They have a database that they've built up over years. So when a user, or they also have connection with the national police in Japan, when a new spam number or email address has been identified, that goes into the database, and then of course it benefits everybody else within the network so that they'll know if they're approached by one of these fraudsters that it is certainly a fraud call or fraud SMS. They haven't been public for very long, and they're somewhat of a small company, so we have sized the position reflecting this at a 1.5% weight. But we have, recently added to the position, I think last month at around 795 yen. Again, reflective of the fact that we think that this position or this stock represents excellent value at these levels. So we expect them to continue to grow their earnings at, say, 10 to 15% over the long term. You combine that with the valuation they're at right now, we think investors from this point, the forward rate of return is going to be very strong.
Okay, time now for Alex Roos's top picks. Number one on this day, Polaris Renewables, ticker symbol PIF on the TSX. Alex?
Yeah, and so, we started the show talking about, it's an expansive market, but yet there's huge opportunities if you're willing to dig around the market. And this is one of them. This is a ridiculously cheap stock. So Polaris is a growing producer of green electricity throughout South and Central America. And their biggest project is a geothermal electricity producer, but they also do solar and run-of-river hydro, and I don't think they've done wind yet, but they'll do any of the green power stuff. They have battery projects too. So again, this is an area on the come, and now the green sector has been under a little pressure in the last year, but this stock is just super cheap compared to everything else in the sector, and it pays you a nice dividend. So it's got a 6.65% dividend yield, P of just 13 times, double-digit free cash flow yield, and we think the target in the stock's about $21-22, so you've got probably 70-80% upside from here. And meanwhile, you get paid a super dividend just to sit and wait. And meanwhile, the management's doing a good job here. They're just reinvesting the part of the cash flow they don't pay out as dividend in new projects, and they've got a nice pipeline of stuff to come over the coming years. And then they also, opportunistically make a little bit of M&A of smaller projects that, the likes of the Brookfields, they're just too small to look at some of these projects. And so they have a nice niche, and it's they're just continuing to build this business. So this is going to be a growth stock for years to come, and it's really undervalued. Okay.
That's the number one pick, or the first top pick, I should say, on this day. Pfizer is number two, ticker symbol PFE, a giant of the pharma sector. Alex?
Sure, and Pfizer got a little bit of positive profile in kind of 2021 with the COVID pandemic, as they have the leading COVID vaccine, and as COVID has kind of fallen off in terms of its occurrence and the amount of people taking vaccines, that part of their business has come off. And you had a huge amount of people pile into the stock in 2021 on the COVID play. And a lot of that kind of fast, quick, hot money is exiting and has driven the stock down to basically, I believe it's close to a 10-year low that they hit this year. And so yet the basic business, if you exclude the COVID business, is one of the biggest pharma companies in the world, produces a huge amount of free cash flow, and it allows them to pay almost a 6% dividend yield, which is increased every year. And we think fair value for the stock is in the 40s, which gives you 50 to 60% upside from here.
Okay, then we had a call on Philip Morris, and I think this is you referenced another pick in the U.S. market that would be more socially acceptable. This was it, correct?
Exactly.
Okay, and number three on this day, Tamarack Valley. We go to the mid-cap or perhaps small-cap energy sector here in Canada, TVE in Toronto. Alex?
Sure, and you've heard my comments earlier on the whole oil and gas sector being pretty well undervalued, and this one again as a mid-cap producer is extremely undervalued. It trades around 3 times cash flow, has a double-digit free cash flow yield, over a 4% dividend yield. The stock has probably upside of 50 to 80% here, and then they're actually, in terms of where they're investing, their two biggest plays are the Charlie Lake oil play and the Clearwater oil play, two of the highest returning oil projects in North America. And so that's where the money that they're producing is being reinvested. And meanwhile, they're spitting out a bunch of cash to shareholders. They pay the dividend. Recently, they started a stock buyback, and as their balance sheet starts to get less and less levered, they're going to increase that buyback. Currently, they're not at their target where they go to a 50% of free cash back to shareholders, but they should reach that in the next year, and then that will really accelerate this stock. Meanwhile, it's quite cheap and you get paid to wait.
Do you believe that these stocks need a higher price of WTI to move significantly higher, or is $80 sufficient?
No, and that's, I think that's part of the conversation. Again, if you look at from a longer term perspective, oil moves like, everybody talks about daily moves in oil, and it's all over the place. So this year we've traded between, I think, 67 and 95. So that's a huge trading range. Now, people trade stocks based on that, which is kind of crazy because these companies produce over a 10 to 20 year period, and so you really should be doing a discounted cash flow of that stream of cash. And on that basis, if you go in right at the middle where that's been trading, which is a good estimate where it should trade over the next 5-6 years, it gives you huge amounts of free cash flow, and that's the numbers that myself and other portfolio managers look at when we're making our investment decisions. And so, when we get these down days in oil where stocks will trade off, an oil stock will trade off 10%, those are great opportunities to add to our holdings. And that's exactly what I've done with the portfolio. When the stocks get beaten up, we add to our positions. And then when you get the run up, when oil's at 95 and stocks are hitting all-time new highs, you might trim a little bit or whatever. But from a very long perspective, relative to the rest of the market, these stocks are crazily undervalued, and so you want to have a portion of your portfolio in companies like Freehold and Tamarack and just put it there and wait 5 years, because the cash flows are stupendous, the dividends are stupendous, and the stock buybacks are going to drive these stocks up eventually.
Let's get to that first idea from Hapsnedden. Schneider Electric, a legendary name in electric contracting and equipment.
Yeah, you can see their vans around here and there. They're much bigger and they're France-based, but they're growing. This is a name that you can see there, trades on the over-the-counter gray markets, that we want to hold long term. They are sort of at the forefront. A little double top there there we go. We can kind of look. So a little weakness, we expect a little bit of weakness now. We bought this one, I think we started buying this about a month and a half ago, almost 2 months ago. And we did our initial salvo, just as I described several times in the show. Okay, let's get our 1% in there and see where it goes. But you can see a nice little long-term trend. These guys, what is really exciting about them is that they're part of the digital transformation of energy and the management of it. They're really big in providing all the data centers, which are feeding into the AI. I mean, that's been a little bit of overboard theme, but
sure.
These guys are sort of really at the center of the need to manage energy distribution and delivery, in a different way. And they've got tons of upside. The cash flow has increased on a 1-year basis by 36%, on a 2-year basis by 63%. Ownership is about 90% institutional and fund, and so you're in with people that are a long-term committed, and this is an early idea. It could be volatile in the short term, but I think if we look up 10 years, investors would be happy to own this one.
Costco Wholesale.
Yeah, this one, I don't know if I've ever recommended it. I always look back to see, Andy, okay, have I recommended this before? Why have I never said go buy Costco? It's kind of like the Berkshire, they've got a great model. I know sometimes when my wife says we're going to go to Costco, I'm like, oh my God. Now you can actually go on their website. You can see when they've got it all mapped out when their periods
clever.
are. Yeah, so okay, I'm not going Sunday at 1 o'clock because I'm going to be elbows to elbows with other people trying to get the free food, right? The tasters. But these guys have a model that's no one still can touch it. The moat, as they say, is really wide. They've got a lot of potential in foreign markets. And in all time frames, the stock is technically sound. Can it come back? Yeah, could you come back to the $600 level? And yeah, sure you could. But this is another name like a Berkshire that you should own some of this at some point. They've got a really good business model, pretty basic,
Okay, and Chemtrade Logistics Income Fund, a cyclical stock.
Yeah, cyclical. It's in the right time in the market. They've, this is a Canadian stock. It's when you're managing assets for clients. We're in Canada, but it's hard not to be a homer sometimes. But you have to do the best thing with your decisions. But this happens to be a name that's a really good name. I think it's a good takeout candidate. You can see it's been pretty volatile, a long way to go, but you're getting a nice dividend along the way. You're getting paid a 7% dividend. I don't like high payouts. It sometimes makes me a bit nervous that I might be missing something, but I think it's an underappreciated name. These guys, their business lines are sulfur and water chemicals. So sulfur is for industrials. The water chemical would be sort of the treatment plants. These guys sell all the, you can see there's a long-term trend. We get above this level right around here, and we've got a pretty good upside there. Even moving up to that sort of the 1050 level is a pretty good upside from current level at 7% yield. Their margins are really healthy. They've just gone and raised everything after the recent earnings, raised their guidance and all that stuff. But as I sort of touched on, this high payout and the focused business line they have, and their size, they're not a big company, just under $1 billion. I think at some point someone's going to come along and say, "Wow, these guys are really nice. Let's go buy these guys and see what happens." But I think when you look at the backdrop that we have, what we talked about off the top of, this push and pull, this tension between growth, the Nvidias of the world, and then what we're seeing in the in inflation type related investments, whether it's commodities or energy or whatever. These guys are sort of right on that latter side. They're when you have pricing power like they do, it's and you're in an inflation environment, this is a good name to have. So I think investors will be happy with this thing looking 2-3 years out.
First idea, Boardwalk REIT, the Alberta landlord.
Yeah, Boardwalk REIT is a name we've owned in the portfolio for quite some time, and it just continues to execute in terms of their operational capabilities, and yet the valuation remains compelling. So Boardwalk REIT, 2/3 of its portfolio is in Alberta. Alberta is a growing province in Canada, saw population increase over 4% last year, which is the highest of any province and the highest growth rate for Alberta since 1981. So people are moving to Alberta. They're looking for affordable places to live. Boardwalk provides that. Secondly, not just Alberta, but Saskatchewan. Alberta and Saskatchewan combined, those two provinces do not have rent controls. And those two provinces account for 74% of Boardwalk's cash flow. That is compelling because they're able to sign new leases at 10 to 15% increases. They're able to push out renewals at about 7 to 9%. And cumulatively, that combined with occupancy, you're seeing, they say they're going to generate anywhere between 11 and 14% internal growth this year. So the earnings trajectory is strong. Then we look at valuation. And this is where I just keep it simple. The stock, if you look at it trading today at around $70, implies you can buy Boardwalk at $200,000 per apartment suite. I challenge anyone to build apartments at $200,000 a suite. In fact, we see apartments trading at $270,000 a suite for older vintage product that may not even be comparable to Boardwalk, but at that level, the stock would be north of $110. So we think their own IFRS values of $90 are conservative. In the meantime, we don't have to worry about the transaction market. We can just watch cash flow go higher and net asset value increase.
So how much does it cost? I know it's really hard to generalize, but how much should it cost to build an apartment, Andrew? I know there's all these costs you got to take into account.
I mean, you're seeing new builds trade north of $300,000 a suite. But again, it all depends if it's stick frame or concrete high rise, and then that's not even including the cost of land. So it really all depends, but really at those levels, you can't replicate what Boardwalk has.
Okay. Digital Realty Trust, and remind us what they're all about.
Yeah, so this is the second largest data center REIT globally. I touched on data centers in answering the Equinix question. Data center demand continues to accelerate. We saw record industry leasing of megawatts in the quarter, really 4 times as much leasing done in the quarter than a year ago. And then I look to the health of the tenants. You look at the big tech and their cloud business revenues. Those are up to about $65 billion, which is up over nearly 20% year over year. That's between Amazon, Google, Microsoft, and Alibaba. That means they have a lot of capital to put towards data centers and deploying their cloud rollout, as well as the coming AI boom. So, Digital Realty Trust, they own, call it 300 data centers, 2/3 of which in the United States, great presence globally, and they house the majority of where this activity is happening, and they have pricing power for the first time in many years. So we see, per annum over 5% internal growth, and that could even be higher. That's pretty conservative because it really doesn't give much credit to the AI boom that is potentially coming. So a stock that trades at a modest premium to net asset value, but net asset value is going to compound and increase over many years.
And then finally, Chartwell Retirement Residences. What's the attraction here?
So private pay focused, upscale to mid-market retirement homes across Canada, a premier operator. This one also, I kind of say, is pretty easy in terms of the demographic wave. If you look at the 80-plus year cohort in Canada, it's going to grow 4.3% over the next 20 years per year. So you have demand growth of over 4%. You have limited new supply, call it 1%, at a time where there's already a deficit of housing in Canada. Occupancies at Chartwell are around 86%. They're on a path to 95% occupancy by the end of next year. They did just to give you a sense, they did 640 basis points of growth in the first quarter. And every point in occupancy is over $8 million of revenue. So there's a great path here to increase net asset value and own a great platform in what is a compelling supply and demand backdrop.
A lot of capital is not going into building senior housing or retirement residences?
Thankfully, we're past that wave. We've always had this demand boom coming, and so people were anticipating that, and new construction was high going into the pandemic. We've now churned through a lot of that new supply, and now the demand and supply favors the landlord today.
First idea, Dundee Corporation, DC.A. Now, I know about Dundee Gold or Dundee Mining, but what's Dundee these days?
Dundee is the ultimate product of the old Dundee Bank Corp, Ned Goodman's holding company. Went through a lot of changes, really became a dog's breakfast towards the end of Ned's life. The son, Jonathan Goodman, has really, really, really refurbished the company. I would call this a deep value story, which is to say that the sum of the parts, I think, is probably worth 3 times the market capitalization of the whole. Jonathan has become a consummate merchant banker. In fact, I think that their holdings in Reunion Gold by itself, one of my former top picks, is worth the entire market capitalization of the company. They have a range of other assets. I would say that one of the things that holds the stock back is, in fact, the company's complexity. It isn't a simple story to understand. But something selling for a third of what it's worth with a good management team is easy to understand. The other knock against it is, although it's primarily a mining merchant bank, they have a large holding in a medical or biotechnology company that's difficult for mining people, myself included, to value. But when I look at their holdings of things like Reunion, Magna Mining, Maritime, I really truly believe that the company is worth a substantial multiple to the parts. I'm also attracted to it because I owned the predecessor in the early part of the 90s when it too was out of favor. And I watched the predecessor, Dundee Bank Corp, go from about 70 Canadian cents a share to $42 a share, which gives you some idea of the inherent leverage in mining merchants banks when mining's place in capital markets goes from hated to loved, which is something I suspect happens in the next 6 or 7 years.
Okay, I should have said Dundee Precious Metals when I was talking earlier about another company in the stable. Your next idea is a company called 180 Gold. Where are they active, please, Rick? I-80 Gold is Ewan Downey's latest effort. Ewan, despite his young age, has been a serially successful mining company builder. The stock was really depressed because one of the large shareholders there was Equinox Gold, which you talked about earlier on the show. Equinox sold their position in I-80 to fund completion of their mine in Ontario, which meant that you had a very large seller in the market for the last 4 months, which has depressed the market. I-80 is active across Northern Nevada, where their management team has a lot of expertise. And as I say, I recommended it as on a sort of a timely basis because the stock was depressed as a consequence of the needs of a seller. And that seller's gone. The stock can go up now.
Okay. And then finally, Bravo Mining, BRVO. Tell us about them, please.
Let's start by saying it's highly speculative. It's an exploration stock. They've made it a very important platinum group metals discovery in Brazil. Platinum group metals are out of favor, which of course means I love it. You know, I always tend to gravitate towards hate. What made me call it to your attention on BNN is the fact that on the same concession, they have made a discovery with a very different style of mineralization. And it appears to me that they may very well have made what is called an IOCG, or iron oxide copper gold discovery, on the same concession. The core is extremely attractive, and it's too early to say whether my interpretation is correct. But if you have the underpinnings of value around what I think is a very attractive platinum group metals discovery, and you add on to that the potential of a gigantic and high-grade iron oxide copper gold discovery, effectively on the same concession, you have a chance for real outperformance. Your listeners will need to know that this stock is both highly speculative and very thin. And I don't want all of Canada rushing into the stock simultaneously. Use good till cancel limit orders and a speculator's mind frame if you're going to pay attention to Bravo. But I had to bring it to people's attention as a consequence of potential discovery that's only 10 days old.
So I suppose buying a stock is an art. You don't. You want to find a quiet afternoon when people are drinking pina coladas and trading as illiquid. That's when you make your bid.
Oh, I think that's right. Or you use a good till cancel limit order and understand that you might not get filled for 6 or 7 weeks. The idea that you compete with all of Canada because you heard a good idea on BNN and you try and get filled in 10 minutes on a thin stock is not the right thing to do.